This is not how economic power transfers. There are no treaties signed, no formal announcements of withdrawal, no ceremonies marking the end of one era and the beginning of another. What happens instead is quieter. A factory that was going to be built simply isn't. An investment that appeared certain gets postponed indefinitely. A corporate board in Stuttgart or Tokyo looks at projections for North American operations and decides that certainty matters more than market size. Most people think this is about tariffs. History suggests it was always about something more fundamental. $40 billion vanished from market valuations in the automotive and manufacturing sectors between January and November 2025. This was not speculation. This was capital destruction tied directly to investment decisions that were canceled, delayed, or relocated. Volkswagen's announcement in September represented the most visible symbol of what had been happening quietly for months. The company terminated plans for a $20 billion manufacturing complex in South Carolina. Not postponed, not restructured, canceled. The stated reason was operational flexibility. The actual reason was that the United States had become impossible to plan around. For corporations making decisions about where to place billion-dollar facilities that will operate for 30 years, predictability is not a preference. It is a requirement. Manufacturing operations involve supply chains spanning multiple countries, workforces that must be trained over years, and capital equipment that cannot be relocated once installed. These decisions are made based on assumptions about trade policy, regulatory frameworks, and political stability that extend decades into the future. The Trump administration's approach to trade policy destroyed those assumptions. Not gradually, abruptly. The decision to impose tariffs on Canadian steel and aluminum while characterizing them as national security threats. The repeated suggestions that trade agreements could be renegotiated or abandoned based on political considerations. The public statements treating international commerce as zero-sum competition rather than mutual exchange. Each of these created uncertainty that made long-term planning impossible. Corporate strategists operate on probabilities. They can manage known risks. They cannot manage unknown risks. When trade policy becomes unpredictable, when tariff rates can change based on political mood rather than economic logic, when international agreements are treated as temporary arrangements subject to unilateral revision, the only rational response is to reduce exposure. This is where leverage quietly reverses. Because while American political leaders were focused on demonstrating toughness through trade confrontation, they failed to recognize that in a globally integrated economy, capital has options. Manufacturing facilities can be placed in multiple locations, supply chains can be restructured, market access can be achieved through different configurations. The question is not whether companies need access to American consumers. The question is where they choose to locate the operations that serve those consumers. Volkswagen's canceled investment represented more than $20 billion in construction spending, equipment purchases, and direct employment. But the economic impact extends far beyond what appears in press releases. Every major manufacturing facility creates multiplier effects through supplier networks, service industries, and regional economic activity. Standard economic models suggest that manufacturing investments generate additional economic activity worth 3 to 4 times the direct investment. A $20 billion facility creates 70 to 80 billion in total economic value over its operational lifetime. That value is now being created somewhere else, not in the United States. The decision was not made impulsively. Volkswagen had spent 3 years on site selection, environmental assessments, and negotiations with state and federal authorities. The engineering specifications were complete. The supplier agreements were negotiated. The workforce training programs were being designed. Then the company stopped. Not because the business case had changed, because the risk profile had become unacceptable. What changed was not the attractiveness of the American market. Americans still buy millions of vehicles annually. What changed was confidence that the operating environment would remain stable enough to justify permanent infrastructure investments. The possibility that trade policy could shift dramatically based on electoral cycles or political pressures meant that billion-dollar decisions made today could become liabilities tomorrow. Other companies reached similar conclusions without public announcements. Investment that simply didn't happen. Expansions that were quietly shelved. Projects that never advanced beyond preliminary discussion because corporate strategists recognized that the United States had moved from predictable to volatile. This category of economic damage is invisible in conventional statistics. GDP figures capture what is produced. They do not capture what was never created. Employment reports track jobs that exist. They do not track jobs that were never formed. The economic cost of investment that doesn't occur cannot be measured directly. It appears as absence rather than loss, but the absence compounds. Because manufacturing operations that are not built in 2025 would have been hiring workers in 2026, purchasing equipment in 2027, generating tax revenue throughout their operational existence. The decision not to invest creates a void that persists for decades. While American manufacturing investment was declining, Canadian investment was accelerating. Volkswagen's canceled South Carolina facility was followed by announcement of expanded operations in Ontario. The reasoning was straightforward. Canada offered access to the same North American market with greater policy stability, more predictable trade relationships, and lower political risk. The investment differential became stark by late 2025. Foreign direct investment into Canadian manufacturing increased 34% year over year. American manufacturing investment declined 18%. The gap represented more than statistical variation. It represented capital reallocation from a jurisdiction perceived as unstable to one perceived as reliable. This shift was not driven by labor costs or resource availability or technological capabilities. Canadian wages are comparable to American wages. Both countries have skilled workforces. Both have advanced infrastructure. The difference was governance. Canadian trade policy operated within established frameworks that provided certainty about future operating conditions. American trade policy operated based on executive discretion that could change arbitrarily. For corporations allocating capital across borders, that difference was decisive. The immediate impact appeared in employment data, though the full effect will take years to materialize. Manufacturing job growth in the United States stalled in 2025 despite strong consumer demand for manufactured goods. This was not because manufacturing was declining globally. It was because manufacturing investment was being directed to other locations. The jobs were being created. They were being created in Canada, Mexico, and other jurisdictions that offered more predictable operating environments. American workers applying for manufacturing positions found fewer opportunities, not because their skills were inadequate, but because the facilities that would have employed them were being built elsewhere. The economic opportunity was transferring geographically based on policy decisions made in Washington that prioritized symbolic toughness over strategic positioning. The fiscal implications extended beyond immediate employment effects. Manufacturing facilities generate substantial tax revenue over their operational lifetimes. Property taxes on industrial facilities, income taxes from employee wages, sales taxes from equipment purchases, and operational spending. A single large manufacturing complex can contribute hundreds of millions in tax revenue to state and federal governments over 30 years. Canceled investments mean canceled tax revenue. The fiscal gap appears gradually as budgets project forward and realize that anticipated revenue streams will not materialize. State governments that had planned infrastructure investments around expected tax receipts from new facilities found themselves revising projections downward. Federal revenue forecasts that incorporated manufacturing growth began adjusting for slower expansion. This creates a feedback mechanism. Lower tax revenue requires either reduced government spending or higher tax rates on remaining economic activity. Both options reduce economic competitiveness further. Reduced spending means less infrastructure investment, lower education quality, and diminished public services that affect business location decisions. Higher tax rates on remaining businesses encourage additional capital flight. The compounding effect is not immediate. It develops over years as the absence of investment that should have occurred creates gaps that widen progressively. By late 2025, the pattern was clear enough that investment banking analysts began adjusting models for North American manufacturing allocation. The assumption that the United States would capture a proportional share of manufacturing investment based on market size was replaced with risk-adjusted projections that incorporated political volatility. Canada's projected share of continental manufacturing investment was revised upward. American projections were revised downward. These revisions matter because they influence where subsequent investments are directed. When financial models indicate that Canadian operations offer better risk-adjusted returns than American operations, capital flows toward Canada. The initial shift creates momentum that reinforces itself. This is not a crisis. It is a reordering. The most significant aspect of this transformation is its durability. Manufacturing facilities built in Canada in 2025 will operate for 30 years. Supply chains established to serve those facilities will persist. Workforce expertise developed around those operations will concentrate in Canadian locations. Once capital infrastructure is placed, it does not relocate easily. American policymakers who imagine that future political changes could reverse these trends misunderstand the nature of capital investment decisions. Companies that were burned by policy volatility do not quickly forget. Even if subsequent administrations offer more predictable trade policy, the memory of arbitrary disruption influences future decisions. Risk assessments incorporate historical behavior, not just current promises. The question facing American economic strategists is not whether consumer demand for manufactured goods will persist. Americans will continue buying vehicles, electronics, machinery, and industrial equipment regardless of where those products are manufactured. The question is whether the economic value created by serving that demand will be captured by American workers and American communities, or will flow to other jurisdictions. Current trajectories suggest the latter. Manufacturing to serve American consumption is increasingly located outside American territory. The jobs, the tax revenue, the technological development, and the economic multiplier effects are being generated elsewhere. American consumers provide the demand. Other countries capture the production value. This represents a fundamental shift in economic geography that has not occurred in living memory. For 70 years following World War II, the assumption was that major manufacturing serving North American markets would be located primarily in the United States. That assumption no longer holds. Canada has emerged as an equally viable, arguably preferable, location for manufacturing operations serving the continent. The shift happened without military conflict, without economic collapse, without any of the dramatic events that typically accompany transfers of economic power. It happened through accumulated decisions by corporate strategists concluding that the United States had become too unpredictable for long-term capital commitment. Volkswagen's canceled facility is not an isolated incident. It is a visible marker of a broader pattern that will define economic development for the next generation. The manufacturing investment that should have occurred in the United States between 2025 and 2035 is being redirected to more stable jurisdictions. The economic consequences will compound over decades as the absence of that investment creates progressive divergence in regional prosperity. This is where power stops explaining itself. The United States retains the largest consumer market in North America, but control over production increasingly resides elsewhere. Consumption without production is not economic strength. It is dependency. History does not reverse because it is misunderstood. Await further instruction.